Good morning, everyone, or good afternoon. We're here on Saturday taking some live questions and answers on PPP and the employee retention credit. So feel free to throw any questions that you have into the question panel. We'll be looking at those as we go through today and then try to get to as many as we can in the 30 minutes that we have. If you have any other questions that we maybe not get to today, feel free to email us there. You can see our emails here on the bottom of the slide. Kevin should be joining us here shortly. He can answer some questions as well. Alan's not joining us this morning or this afternoon, but he is going to be around. So tomorrow, Alan's going to be giving a presentation on forming and supporting your community band. He has a charitable foundation that he set up in the name of his mom, Sarah Gassman. They do piano lessons for underprivileged children, and they have recently started a small band. So he's just going to go through some of the steps and how you can use a charity to do things like this, and how to use a small charity. So it should be an informative presentation, how to start a charity with nominal money. It doesn't necessarily have to be millions and millions of dollars to do a foundation. You can do it for small things like that. Just a brief warning, we're still interpreting the rules. We're still trying to figure out how these apply. Things change constantly in this world. Kevin, I see you popped in there. As you know, we've had a roller coaster ride here, and so some of the things we might tell you today may change tomorrow, but we'll try to do the best to keep you updated with the information that we do have. So just a brief introduction here. We have a chart with the majority of the CARES Act support programs. There's the Paycheck Protection Program on the two left side columns, the Employee Retention Credit for 2020 and 2021. We have the HHS Provider Relief Program, the EIDL loans and grants. So some of the basic requirements there for both of those. So I'm seeing some questions coming in here, and let's just go ahead and get started with those. So the first one I'm seeing from Alexis is Q4 2020 as a reference period against Q1 2021 a possibility? And I think the answer there, and it's a little bit confusing, is that when you're comparing quarters, you're looking at the same quarter in the previous year almost always. The only exception to that is if you're not in business for the entire 2019 year and you don't have a quarter to go back to, there's the ability to use a couple of different quarters as reference periods there. But if you're in business all of 2019, you have to compare Q1 of 21 to Q1 of 2019. The exception being for 2021, you can actually use the prior quarter. That doesn't mean you get to use Q1 21 against Q4 of 2020. What that rule is saying is that you actually go back and you look at Q4 of 2020 compared to Q4 of 2019. So it's still the same quarter in the prior year. You just have the ability to go back one quarter and use that as your reference period. If you're in quarter two, and you don't meet the test in quarter two of 2021, you can go back and look at quarter one of 2021 and compare it to quarter one of 2019 to see if you qualify. Okay, next question here. Did the new rules alter the length of the covered period for PPP loans in 2020? And then can a PPP loan in 2020 use a covered period of 15 weeks, for example? Kevin, I'll let you handle that one.
Brandon, tell me that one again, just because I'm not seeing the questions pop out on my screen, unfortunately. Okay. So yeah, you'll have to read it to me.
It's saying, did the new rules alter the length of the covered period for PPP loans in 2020? For example, can you use a 15-week covered period in 2020?
Right, they can use a 15-week covered period for 2020. The covered period didn't change really. If we think about it from back when the SBA gave us guidance on the covered period issue, it was a long time ago in which they told us that we could select the covered period we want to use based on when we use up all of our PPP funds. So the covered period rule for both the first draw loan and the second draw loan remain pretty much the same, and that is that you can use up to 24 weeks in either of the two loans. There's no difference as far as that's concerned.
Yeah, and I think the only real change, as Kevin mentioned, was that you can end your covered period at any time you want, regardless of whether you spend all the loan funds. The previous rule required you to spend it all before you ended it. There could be situations where you might do that. Most of the time, you're going to spend all the loan funds before you end the covered period anyway, but that's the only real difference.
Correct.
So Lori says, are the close down and revenue reduction requirements an and or an or? And that's an important clarification. It's an or. So you either have to meet the revenue reduction threshold, that's the 20% reduction in 2021 or 50% in 2020, or have your business partially suspended. And it doesn't matter what the revenue reduction might be if you have a partial suspension. And the IRS has several FAQs on their website that go through what's considered to be a partial suspension and do a pretty good job of explaining that. And they're pretty liberalized compared to what most people might think at first glance. I know one specific question we had, and then Kevin, I know you gave some comments on this in an email related to a restaurant. If they were open for takeout, open for outdoor seating, but had limited seating inside, is that considered to be a partial suspension of the business? And there's actually a specific example that addresses that and says that even if you have just a limited seating inside, that's considered to be a partial suspension of the business, and the entire business would be eligible for the credit to the extent that they are shut down inside. So restaurants in particular could get a great benefit from the retention credit. Kevin, anything to add?
Yeah, Brandon, let's really emphasize the either or part, because I received a lot of emails today, probably 24, just asking about the percentage decline in gross revenue versus a closure order or a partial closure order. Those are absolutely two separate computations. The only time I think that we would really necessarily do a computation for both would be if we have a partial or full shutdown order applying to our business indirectly. If you look at one of the IRS FAQs, it talks about whether or not you are if you have a significant decline in your revenue. Actually, they don't use significant, Brandon, they use the word nominal. I actually looked up the definition for nominal. Nominal just means small, a small change. So if you're subject to a closure order and you have a 41% drop in revenue, that's certainly nominal, but it's not more than 50%, but that's okay because you still have the closure order to rely on. I think the big distinction, Brandon, is the timing. If you're subject to a closure order, the employee retention credit is only going to be calculated on the wages paid during that closure order for whatever time frame it was. Whereas if you meet the revenue decline, you're going to measure your wages for quarters, right? So if you have a 55% drop in revenue in Q2 of 2020, all of Q2 qualifies. It doesn't matter if you were subject to a closure order for only 2 weeks or 3 months. You've met the revenue decline. So that's really the only distinction there. I think that's going to create a bit of a problem for some borrower or some PPP borrowers and employee retention credit people to try to figure out what wages to use for each.
Yeah, really good point. And here's another good one. And Kevin, I'll let you handle this one as well. I don't know that we know the exact answer to this. It's a timing issue. If we amend our 941s in 2020 to retroactively claim the credit for 2020, do we have to reduce our wages for the period that we get the credit on in 2020, or can we just reduce our wages in 2021?
That's a really good question, Brandon, and I don't know the answer to it yet. I probably would tell somebody to go ahead and see if they apply and get the credit. But if they're a cash basis taxpayer, technically they probably could still take the deduction in 2020 and then do the reduction to the expense in 2021 based on their, the cash basis of accounting. We're gonna have to wait and see how the IRS gives us some direction on this. It kind of puts some of our tax filings on the pause because of that alone.
Yeah, and that's a good point too. And that's another question we get is how does the employee retention credit impact taxes? And the receipt of the credit is not taxable, but you do lose the income tax deduction to the extent that you receive the credit on the wages. So if you're claiming, $10,000 of wages in 2020 for a particular employer, you get a $5,000 credit. For the payment of those wages, you only get to deduct $5,000 of the wages, not the full $10,000, because you are reducing your reduction to the extent that you received a credit. Here's one on the Paycheck Protection Program about submitting documentation to show your revenue reduction, which is one of the requirements for PPP2. You have to have a 25% reduction in your gross receipts to qualify. And the lender is saying that they have to use 2019 versus 2020. And she's asking if she can submit quarterly loss statements. And the rule there is that the statute actually says that you compare quarter to quarter to compare your revenue reduction. So you should be able to compare quarter to quarter. If you have a reduction in any one of those quarters for 2020, you qualify. There was interim final rules that allow us to compare the full 2020 year to the full 2019 year as an alternative to just comparing quarter to quarter. So you can also satisfy it that way. It's not a rule that it has to be the full year reduction. The rule is the quarter by quarter reduction, but they also allow you to show the full year. So I think the bank may just be a little bit confused there. You should be able to submit either one of those to meet the test.
Brendan, this is probably one area that we're getting the biggest amount of kickback from on the lenders, because we're seeing lenders request proof of the revenue decline, even for borrowers who are borrowing $150,000 or less, when the rules seem to indicate that we can provide that proof of decline on or before we apply for the forgiveness of the loan, not necessarily when we apply for the actual loan itself. So I think in this case, it's just a matter of the lenders kind of getting up to speed with what the rules are. But I've seen that issue pop up a little bit now with some of our people that have tried to get the round 2 loans. It's also really important to understand that if you weren't in business for all of 2019, then there's different rules you have to look at for showing the decline in revenue. So that's the only thing I'd probably qualify by saying is that if you were in business for part of 2019, then you've got to be a little bit more careful with what period you compare to. But again, I really want to emphasize too that the revenue decline requirement is only for 1 quarter. And so if you show a 25% or more decline in any 1 quarter, you qualify for round 2, period. And I just looked at somebody yesterday whose quarter 2 2020 compared to quarter 2 2019 was a 25.02% drop in revenue. And Brandon, you can correct me if I'm wrong on this, but I believe it's a bright line test. It's 25% or more, 25.02 qualifies.
Yep, exactly. That's it's funny how close these actual calculations are for a lot of people, and it really is dependent on down to the dollar in some cases of whether or not you meet the test.
Yeah.
So here's a question on PPP and the employee retention credit coordination. So if you use an employee's wages for the ERC, we know that they're not also allowed to count towards your PPP forgiveness. But the question here is, can they also be counted as an FTE for purposes of PPP?
And the answer to that's yes.
Yeah, I think exactly right, that you still have to consider them as an employee, even though you're not necessarily counting their wages. You would still have to maintain their wages and still keep them employed for your covered period to avoid a reduction of loan forgiveness. Okay.
Brandon, Bart has a good question regarding using a PEO or a third-party payor. You should be able to apply for the credit through them as well. I believe that PEOs are going to be probably getting some more guidance on how that works.
Yeah, I think so too. They address it briefly in the FAQs, but don't do a very good job of explaining it. So right. More guidance there is definitely needed. So my business started in Q1 2019, so revenue of that quarter is very low. Can Q1 2020 be used instead as a reference to determine eligibility? And that goes back to if you weren't in business for the full 2019 year and you started in Q1, I think you're actually comparing your first quarter of 2020 to your second quarter in 2019, I believe is the alternative test. And there's guidance on that in the FAQs. If you go to the IRS website and search for employee retention credit or Paycheck Protection Program, they'll give you guidance on what reference periods to look back on for those.
Yeah, you guys, Brandon, you guys published that really good chart that showed that. So our viewers should probably pull that up, or we could possibly include that in the slides before this or when this gets sent out.
Yeah. Yeah, we'll send our comprehensive deck to everyone that on here, and it'll be included in there as far as what employers you compare to. All right. Can we still go back and get ERC for last year for Bill? And Kevin, you want to address how do you go back and get that retroactively?
Sure. The one way you could have done it is on your fourth quarter 941, but you've likely filed that by now if you file on time. So the way you're going to do it is just by filing a 941X, which is an amended payroll tax return, to claim the credit. There's a specific line on the form for claiming that credit. It's essentially a refundable credit. So that's the procedure for doing it. So the answer to Bill is yes, you can definitely do that.
All right, here we go. This is a good question too. Since your first PP was determined from your 2019 Schedule C for self-employment income, now that you have actually completed your taxes, you found out that 2019 was actually a loss. Can you still apply for the second PPP? And I think that might be a little bit of an issue. You could apply based upon estimates, and I think if those estimates were wrong and now that you actually have a loss, you probably weren't eligible to get anything from PPP. So I would consider reaching out to your lender and maybe returning those funds because it doesn't seem like they're qualified. Kevin, any thoughts on that?
Yeah, I would probably reference you to the January, I think it's 15th, procedural notice from the SBA talking about errors in calculating the first draw PPP loan. They specifically say that if there was an error, and it doesn't really say intentional or unintentional, just as error, which is a good thing. You base your forgiveness on what the correct amount should have been. So if your correct amount of your loan should have been 0, then you don't have any PPP forgiveness. You probably just need to pay back the loan.
Mm-hmm. Yep. Here's another good one. Are there special rules for owners of S corporations or their family members for purposes of the employee retention credit? And that is a tricky one. There are guidelines under the IRS FAQs that say if you have an individual related to more than a 50% shareholder, that their wages do not qualify for the employee retention credit. They define related party as basically any relative that you can think of, in-laws, father-in-law, mother-in-laws, brothers, sisters, cousins, nieces, nephews. But what's not mentioned in there are owners of the S corporations themselves or the spouse of the owner. So we think that those two can qualify. So if you're paying yourself a wage or you're paying a spouse a wage, you can claim the credit on that. But if your son is in the business and working for the business, even as a legitimate employee for the entire time the business has been opened, the rules are limiting those wages from counting towards the credit.
Yeah, I'm hoping, Brandon, that we get some additional guidance on that at some point, because that's been a question that a few people have posed to me. Is it doesn't make sense that I qualify as the business owner, but my son who works full-time in the business doesn't qualify. And that's a valid question. So we're kind of hoping for some guidance on that. I'm hoping the guidance doesn't tell us that the owner and the owner's spouse don't get counted either. I'm hoping it's saying that, you know, anybody who effectively works in the business should be counted. And to that point, another viewer has the question of, do S corporation owners that are 100% owners or 50-50 owners qualify for the employee retention credit? And the answer would be yes. As of right now, they do. So just because they're an owner doesn't mean they don't qualify. Just remember that we still have the limitation on how much wages we can use for the employee retention credit.
Exactly. And you know, thinking about that one, you could see where the intent of the statute would be. I don't want you to hire your son and claim wages for them and get a credit for it. But it seems like if someone's a legitimate employee of the business, has been working there for years and years, that they shouldn't be limited. But nevertheless, that's what the rules are currently saying right now. Here's one from Tanya. What is the required documentation to prove gross receipts reduction of 20%? And I think we can address this for both PPP and ERC because I think they're similar. And for PPP, you can, I think the easiest way to do it is look at your full 2020 year versus your full 2019 year. And if you have a 25% reduction there, you can just submit the tax returns and show your receipts on the returns. If you're looking at quarter by quarter, then it's some sort of quarterly financial statement or a bank statement where you go through and mark all your gross receipts and add them all up and put them in some sort of formula, Excel spreadsheet to show that reduction. Having any other documentation?
Yeah, just based on actual experience so far, Brandon, we've had some people submit things like sales tax returns, bank statements, sales ledgers, and in all three of those circumstances, the lender declined to accept that as documentation for a decline in gross receipts. So it looks like the lenders are pretty much sticking to their guns that they want a financial statement, a profit and loss statement, or like you mentioned, a tax return if you're going to use the entire year. But I would just warn people that if your revenue for the entire year is only down, say, 18%, that doesn't mean you don't qualify. You need to go quarter by quarter and see if there is one quarter that you do have that 25% or more decline, and do the homework to make that happen. If historically you don't do your financial statements monthly or quarterly, at least make the effort to calculate your revenue for those periods to see if you qualify. It's worth the effort.
Yep. Really good point. Can I use both programs against one paycheck? For example, I have someone making $2,500 a week, so I can use the maximum of $1,923 of that check for PPP loan forgiveness. Can I use the excess for the employee retention credit? And I think that's the right analysis and the exact way to go about this is, you're as long as you don't double dip, I don't think it really matters where it comes from. As long as you're not counting the same wages twice, you can really use it in any way. The question is how we are reporting this and what the, either the Treasury or SBA is going to require to make sure we're not double dipping in any way, and we don't have guidance on that yet.
Yeah, we don't, Brandon. Now that's the tricky part, because in all the PPP work we've done so far, we've never really had a mechanism to tell the bank, the lender, the SBA, we're specifically picking this payroll for our PPP. We've had a lot of people turn in PPP forgiveness applications with, $400,000 or $500,000 of payroll alone on a $250,000 PPP loan. Clearly, the payroll way exceeded the PPP loan amount in that particular circumstance, but we never really said, well, we're only going to pick this $250 of payroll for this $250 of PPP loan. And now it kind of seems like we're going to have to maybe do that somehow if we qualify for the employee retention credit. Again, no mechanism for on how to do that, but I think we're going to have to do that at least on our books so that we can prove it later if somebody asks us.
Yep. Next question is, I have a corporation with a fiscal year ending October 31st. Can I use the fiscal year quarters to compare for PPP2 purposes, or do I have to use the actual calendar quarters? And to be honest, I'm not sure the answer to that question. Kevin, I don't know if you've looked at that at all or not.
You mean as far as whether or not they do fiscal quarters versus calendar quarters? Right.
So their question is, my Q2 is February through April and not, the typical March or April through.
Yeah, and I actually had this question pop up already for somebody who has an April 30th year end, Brandon. And when I went back to recheck it, if you look at the, I don't remember now where it's at exactly, if it's in the IFRS or the FAQ, but there was a reference to calendar quarters, Brandon. So I think that to me, calendar quarter means the calendar year. So it might mean that you would have to go back and calculate your revenue based on calendar quarters, even though you're on a fiscal tax year. I only found that in one spot. If you don't qualify by measuring it on calendar quarters, but you did on fiscal year quarters, I would certainly submit that to the lender and see if they submit a request to the SBA to get clarification on that.
Yeah, you can't ask you don't get what you don't ask for, right?
Exactly.
So here's a good one. Any resolution on the basis argument for when basis step up occurs when you receive PPP loan forgiveness? And still no clarity from any from the IRS on this issue. Our position on that is that you essentially use the revenue ruling that the IRS had related to the non-deductibility of expenses, saying when you had a reasonable expectation of loan forgiveness, that the loan was deemed to have been forgiven and therefore you cannot deduct the expenses in 2020. I think you use the same argument here and say, I have a reasonable expectation of loan forgiveness in 2020. Therefore, my loan is deemed to be forgiven and I'm taking the basis increase in 2020. I think that you have, authority for that. And, unless the IRS comes out with guidance to the contrary, I believe that is the treatment for now. Kevin, any thoughts on that one?
Yeah, Brandon, my thought is because the tax return doesn't have a mechanism to show the basis increase, like for, let's say, an S corporation, if the loan is still on the books, you can't also increase the AAA or the equity of the company on the balance sheet, which usually affects the basis. So if you do leave the loan on the books but increase basis, you're going to have some reconciliation for that, internally, maybe on your tax work papers, if you will. So I wouldn't really bother with increasing basis unless I needed to have increased basis. And you do know that you're going to get full loan forgiveness. You have a reasonable expectation that you will. Otherwise, I would probably just wait until you actually get the formal forgiveness letter from the lender and take the PPP loan from debt to other income at that point.
Good point. Yeah, no point of messing with it because it's clear that you would get the basis increase when the loan is actually forgiven. So unless you actually need it, no point of really trying to mess with it. But if you actually need it, I think there is authority to take it if you do. You have a 25% drop in a quarter, but the business is still doing well. Can you get a second PPP loan? And that's a really good question. And one that I think a lot of people are glossing over is that this necessity requirement is still out there for PPP2. So just because you meet the revenue reduction in one quarter, you might have, so let's say, for example, you were shut down in quarter two and you had a 50% drop of your revenue. So you qualify and you meet the first test. But quarter three and quarter four were your best quarters that you've had in years, and the business bounced back strong, and now you're doing well. I don't think the loan's necessary to support the ongoing operations of the business, so that business would not qualify. And I think that's an important part to look at it. Even if you had a bad 2020 year and you have, a lot of excess cash in the bank, and you can use that cash to support ongoing operations and get you through the next year, I don't think the loan's necessary. You should not consider applying. So the necessity requirement is still there. It's a second requirement in addition to the 25% reduction test. All right, here's another one. Covered period starts with the funding date. Is that correct? And yes, that's the correct answer. And the other thing just to add on there is the alternative covered period, where you could start your covered period on a payroll date, is no more. They have eliminated that. It's now strictly the day you receive your loan. That's the start of your covered period. Okay, for the employee retention credit, if one individual owns 3 S corporation dental offices, do you look at the revenue and wages as one company or each individually? And the answer to that is you have to aggregate the businesses if there's common ownership, and there's affiliation rules that apply. So if they're affiliated entities, then you're aggregating all those together to determine if you had the revenue reduction.
But Brandon, one thing I want to point out there that is important to discuss there is that means that as an aggregated unit, if you have, say, one location or one business that did poorly, but maybe the others did okay, you might in the aggregate qualify. So it could actually benefit you depending on the circumstances.
Yeah, and then the other part of that is, say if it was a, business like a franchise that had multiple locations, and maybe, in Florida we weren't shut down, but they have a location in Virginia that was shut down. Because they're an affiliated group and that location in Virginia was shut down due to an order, the entire group can qualify now because a part of their business was suspended. So that's another important clarification. So that can work for or against you either way. I think we've answered some of these. Here's Kevin, you just want to review, there's one, can you please explain again how to reduce wages for income tax purposes when you get the retention credit?
You don't really reduce wages on the tax return. Let's say that you file a tax return and you have $100,000 of wage expense. That still shows up on your tax return. as $100,000, but on your books rather, I'm sorry, on your books. And then what will happen is when you reconcile your book net income to your taxable net income, let's say that you had a $20,000 employee retention credit related to that $100,000 of wages. So your wages deduction on your tax return will show at $80,000. And when you reconcile your book net income to your taxable net income, which is generally done on Schedule M1 of a business tax return, you would show that $20,000 difference between your book expenses and your tax expenses. So like Brandon said earlier, the ERC credit does reduce your deduction for the wages because the government was essentially subsidizing your wage expense, which is unlike the PPP loan forgiveness.
All right, so I think we are running out of time here. Kevin, any questions that you saw on there that we wanted to address that you thought were good?
Brandon, I actually tried to scroll forward because we had a ton more questions that we had time to cover, unfortunately. But if you guys, you've got our email addresses. If you want to try to send some of these questions to us, we'll try to handle them for you. But yeah, it really, I think the most important thing, if I could say anything right now to anybody listening that has a PPP loan and is looking at the employee retention credit, is really just to kind of like step back, kind of take a breath. Don't do anything with your PPP loan forgiveness for the first draw loan. Just put that on hold for right now. I was told by Republic Bank on, I think Wednesday or Thursday, that the SBA is not going to start accepting the 3508S, which is going to be the forgiveness application form for loans of $150,000 or less until sometime in March. So we have a little bit of time if we have smaller loans to actually take a breath and put that on pause. And then we can look at the employee retention credit issue as almost a separate issue for 2020. So probably keep calm is what I tell everybody to do as far as that's concerned.
Yeah, good point there, Kevin. All right, so we'll probably try to do another one of these and maybe next weekend or the week after and try to get to some more questions. And like Kevin said, feel free to email us. We'll do the best we can to try to get your questions answered. So thanks for tuning in, and we'll try to set another one up and do this again sometime. Kevin, any final words?
Like I said, just hang in there, everybody.
Yep. All right, take care, everyone.